Good evening, everyone, and welcome to week 9. Please forgive my voice if it goes in and out. I've been doing a bit of coughing, so I don't know whether it's just allergies or what I'm dealing with, but I didn't want to bring it on campus, that's for sure. That's why we're doing what we're doing today. So this week we're going to cover Chapter 7, which is discussing capital structure and leverage. So getting right into the material, what is capital structure? This is the paragraph on the top of page 120. Capital structure is that mix of capital utilized by a company in financing its operations, and you can have either, equity capital or debt capital. Equity capital is going to be the money that's financed, provided by the owners, either as initial investment or by the retaining of earnings in the business, which retained earnings, which is that cumulative net income minus any dividends paid. Excuse me. Or capital can come into being into a company by the issuance of debt, and can either be short or long-term accounts or notes payable. And there's also a discussion of a third possibility, and that's kind of a subset of long-term, which is called intermediate term, which are notes that are up to 10 years in maturity. So our types of debt are those three, and these are the three that are discussed 120 to page 121. Excuse me. So your short-term debt basically follows the financial accounting definition of short-term versus long-term. And in that, short-term debt is due within 1 year, generally seen in the form of short-term bank loans and or trade credit. Trade credit, an example of that, I order office supplies from a company called Quill, and they offer just a trade account with a term of 30 days, where I can order my supplies now, receive them, and pay for them within 30 days. And a lot of similar situations are handled for companies in that way. Ordering parts, ordering merchandise inventory, and what have you. So for financial accounting, you had either short-term or long-term. There is this concept of intermediate debt, which is like I said before, a subset of long-term debt. And intermediate debt is not super long-term in nature. It's, there's a maturity date on usually a bank loan that's going to be between 1 and 10 years from issue date to maturity. So you might see this in the financing of things like vehicles, pieces of machinery, equipment, items such as that. Really anything outside of your long-term debt issuances, your super long-term debt, which generally are saved for items like real estate, which can go 30, 40 years. So debt capital usage is your most common type for small business, of business financing. The textbook gave that there is an estimated $1 trillion borrowed per year from lenders for small businesses. This year during the pandemic, that amount has definitely increased because there was the offering of PPP loans and emergency, the economic injury disaster loans, the EIDLs, that small businesses were being offered. So that 1 trillion has definitely gone up this year, possibly even, by many times even that. So your sources for small business financing could be your banks, your credit unions, but also government agencies. And again, going back to some of our CARES Act items, such as the PPP and EIDLs. This is where we've seen the Small Business Association take a larger role. That SBA has been the one granting these loans, and generally you go through a bank, and the SBA guarantees the loan. The bank guarantees the loan. The SBA is the issuer. So for farmers, could be your USDA, U.S. Department of Agriculture, Housing and Urban Development, and also there's state agencies that might give small business loans. And also cities, believe it or not. There are a lot of cities that have what's known as tax increment financing districts and offer loans to businesses that fall within those what's called a TIF district. I know Peoria has several. Chillicothe has, I think, used to have 2 and now has 1. But they offer loans to businesses that are just starting within those districts, as well as some cities have what's known as a help loan. I know City of Chillicothe does, where you can actually borrow money from the city itself at a lower rate in order to help get your business started. So a good place to look for financing, not only the banks, the credit unions, and your federal and state governments, but look to your local governments as well. You might be surprised with what you can find. So debt capital is one form of capital type. Another capital, equity capital, and that's the funds that are invested by the owners and come into the form of the equity section of your balance sheet. So the account types there being your common stock, which every corporation will have. Preferred stock, not every corporation will have that. Preferred stock does not receive voting rights, but they do have first right to dividends. The right to first dividends over common stock shareholders. And then retained earnings being those cumulative net income amounts from the inception of the business, subtracted by, minus any dividends paid to shareholders over the years. Okay, so sources of equity capital, really the fewer owners you have, sometimes the less access you have to capital, and especially in the form of equity capital. So that's why many, turn to debt. So the owner themselves, what kind of assets can an owner have personally? Could be the equity in their own assets, such as equity in your home. You could take out a home equity loan and use that to finance the buy-in to the business. Another and a little bit more of a tax consequence is borrowing from retirement funds. If you just take a 401k loan out on a business or to finance ownership of a business, as long as it's just a loan, there's no tax consequence. When an actual distribution has been made, then especially if the owner is under 59 and a half years of age, not only is that amount subject to income tax, it's also subject to a 10% early withdrawal penalty. So that amount can add up real fast, especially if you're talking about large amounts of money. So some owners will turn to family and friends. Per the textbook, this action actually approximates about $100 billion a year in raising of equity capital for businesses. And there's also venture capital firms, which are businesses that are set up to invest in businesses that are just getting started and looking promising. But venture capitalists are looking for a large payback in a short amount of time. So venture capital is associated with a high risk, but also venture capitalists do provide a pretty decent chunk of financing of private companies, almost 7%, which is not a bad amount. But venture capitalists on a typical turnaround for venture capitalists is a 300 to 500% annual return over the first 5 to 7 years of existence. So they're looking for high profits very quickly. There's also a type of investor called an angel investor. And what those are, generally wealthy individuals who invest in companies, sometimes for reasons other than to make money. It could be that they invest in something like a startup wind farm because this billionaire is interested in renewable energy and is very passionate about it and wants to help this company get started. And Amazon.com is an example of someone who, a company who actually helped get its start by angel investors. So there was $1.2 million from a dozen different angel investors. Amazon.com also raised $8 million from venture capitalists and also raised money from family and friends. So in getting off the ground, Amazon.com did a pretty healthy mix. Excuse me. So it's kind of neat to see where some of the biggest players in the game now, where they actually got their start. So 122 to about page 1, at the top of 125, was a little discussion of debt versus equity financing and what happens to the return on equity if a company uses debt capital or equity capital or a mixture of both. So the reasons that debt capital might be a preferable form of financing a business versus equity. Number one, it's easier to obtain. It's easier to get a loan for $100,000 than it is to make $100,000. And most people that make, that kind of money don't have it saved. So much easier to obtain a loan than it is to actually come up with that much money elsewhere. And also it's less costly to obtain, especially talking about the example I did earlier about taking money out of a retirement account. It costs a lot less to take out a small short-term loan for, say, $50,000 than it would to take $50,000 out of an individual retirement account or a 401k and have to incur, if your marginal tax rate's 22%, and you're under 59 and a half years of age, at $50,000 right off the bat, you pay 32% tax and penalty. And you'd have to take on a lot more than $50,000 to receive $50,000 if you had taxes withheld. So a lot less costly to obtain a loan than it is to borrow or actually withdraw funds from a 401k or a retirement account. A big one is that you can retain your ownership percentage by borrowing money rather than by bringing in additional investors. Retaining ownership means you don't have to give up any power, any control over the company. This means you write a check to a bank once a month. It doesn't impact the owner's decision-making abilities or their abilities to, run the business without having to, ask permission from 50 partners rather than maybe one or two. So you can have some flexibility in terms, such as how long you decide to take the loan out for. Interest is usually pretty much fixed. A huge factor here is the fifth bullet point, and that's the tax deductibility of interest. Versus if you have investors that are wanting to receive dividends, dividends are not tax deductible. So interest is tax deductible, dividends are not. And the debt capital, the more you have in debt capital, the more your company's return on equity is increased. And we go into a little example here. Sorry about that. The phone rang here at I had to come into my office to do this recording so I wouldn't get interrupted like I would at home. But the example that the textbook goes through at the bottom of 122, there is a little modification I'm going to make to that example. And that is, it actually does simplify the example versus what the book has presented. And the book shows on the bottom of page 122, the business tax rate being a progressive tax rate with 4 different percentages based off of how much the net profit in the business is. Currently, the corporate tax rate is 21% of all taxable income for everyone. And so that flat 21% versus the 4 different tiered rates is actually going to make this example a little bit easier, in my opinion. Excuse me. And the solutions will be, posted to a table similar to what's viewed on page 124, table 7.1, but our numbers will differ a little bit just because of difference in tax rate. Okay, so our inputs, our first illustration, we're going to go through a few different scenarios of mixtures of debt and equity informing the business's capital. We're going to start with capital only of 200,000. The next scenario will be equity capital only of double that amount, and then we'll bring in debt. And we'll calculate return on equity for each scenario, and also we'll calculate the change in return on equity from one scenario to the next. So our equity capital only is our first example. We anticipate a rate of return, so what our business net profit will be before any deduction of interest. and before any deduction of income taxes would be about 16%. And then again, our tax rate will be 21%. And we also have, when we get into the debt scenarios, we'll have an interest rate of 13% that we'll be utilizing. So the first scenario to calculate our return on equity, going back to chapter 6, where we discussed the different types of ratio analysis, return on equity is equal to net profit divided by owner's equity. We know our owner's equity in this example, and that's going to be our $200,000 of equity capital. Our net profit can be imputed from that. And so the way that's going to be calculated is going to be, since net profit was expressed as a percentage of our capital, that'll be the basis of the net profit calculation. From that, we'll subtract taxes and any interest. This first scenario and the second, we don't have any interest to calculate since there is no debt capital involved. Excuse me. So going through and doing the number crunching, $32,000 is the base of our net profit, which is 200,000 capital times the 16% anticipated rate of return. From that, we'll subtract our taxes, which would be 21% of our net profit before taxes. So 32,000 represents earnings before interest and taxes. We would take $32,000, subtract any interest, which in this scenario is zero, because there's no debt borrowing. And taxes are the second part of our argument here, and that is our profit. And there would be profit minus any interest. So 32,000 times 21% comes out to 6,720. We subtract the two, our net profit after interest and taxes is 25,280. And now this is a simple division of the two numbers to determine return on equity. So our net profit, 25,280 divided by our $200,000 of capital or equity, excuse me, gives us our 12.64% return on equity. We'll be seeing that number again. Now, the textbook example, that was not the case, and we'll actually discuss why here in a second. So what would happen if the equity were to double and if all that equity were still equity capital, which is now 400,000, still no borrowing? Basically, all of our numbers are going to double, except for our return on equity percentage. So our net profit would be, once again, our 400,000 capital times the 16% rate of return minus any interest, which we can ignore in this scenario since we have no borrowing, and minus any income taxes at 21%. So our net profit, we do the multiplication. The earnings before interest and taxes is 64,000 minus zero interest minus taxes calculated at $64,000 times the tax rate of 21%. So determining the income taxes by the multiplication of 64,000 times 21%, that gives us income taxes of 13,440. subtracting that from our net profit before taxes gives us an after-tax net profit of $50,560. And again, we can divide those numbers now. The net profit divided by the equity. And again, 12.64%. Looks familiar. Looks just like the argument or the solution that we got with $200,000 of capital. And that is correct. And the reason why they're different in the book is that it's because of that old tax structure. Once the net income was over $50,000, the taxes were higher than just, it was not just 15% as the book had. So it's 15% plus 25% on the next, $14,000. So there's a little bit of a loss, a little bit of a change in the return on equity. It was less in the second scenario, and that was entirely because of income taxes. So 2 more examples illustrated in the book from 123 to 124 is what would happen. Now we're going to take this $400,000 total capital and present it in 2 different scenarios. What happens if we have $200,000 debt capital and $200,000 equity capital? How would that change the return on equity from the example prior, where our $400,000 in equity was entirely equity-based? Capital was equity-based, excuse me. So that's example 1. Example 2, what if we have kind of a 3-to-1 ratio of debt to equity capital? How would that differ from the $400,000 consisting of strictly equity capital? And we'll go actually to the tables. And this is a reproduction of table 7.1. It's using the current tax rates. And I tried to give a little bit more example and actually label the scenarios. So we're looking at scenarios 2 and 3, or 3 and 4 here, excuse me. So if we have an equity and debt split evenly, informing our $400,000 capital, our earnings before income and taxes, or for interest and taxes, excuse me, will be the same. Will be the same for all 3 scenarios that involve the $400,000 of equity. Where it's going to differ is going to be where you have your interest calculation. So scenario 3 brings in the calculation of interest on the debt. So 13% is our stated percentage. So for scenario 3, the 13% is figured on 200,000. For scenario 4, that 13% is figured on 300,000 instead, meaning more interest expense. So you can see the corresponding, taxes on the earnings. So in determining our taxes on earnings, we would take our taxes before interest and earnings before interest and taxes, subtract the interest on our debt, and that remaining amount would be subject to taxes at 21%. So then our earnings after interest and taxes would be figured by taking column 4, our earnings before interest and taxes, subtracting the interest paid on our debt, which is a tax-deductible expense, and subtracting our income taxes. So stands to reason the less debt we have, the less interest expense we have, the more net profit we have. But we also have our return on equity, surprisingly, gets higher as our interest expense increases, which is kind of goes against a little bit of logic, honestly. You would think return on equity, you're not going to have as much if you have more debt. Not necessarily so. Because the return on equity is going to be our earnings after interest and taxes divided by the equity capital, not just the debt capital. So that's why if you have more debt, you have less equity. So the bottom portion of your formula is going to be a lower number. So that's the reason why your ROE keeps looking better, even though this company is taking on more debt. So ROE, if you are a business and you're looking for a move that's going to make your ROE, your return on equity, look best, more debt makes more sense. So borrowing is attractive in terms of return on equity percentages. So what about the changes to your interest rate? How would that affect the return on equity? So looking at the final scenario, I'm going to use 3 different percentages and take a look at those numbers in 3 different ways. And that is, what if our interest rate is lower and lower yet and lower yet? What does that do to our return on equity? It's actually going to increase it. Our earnings after interest and taxes, the lower our interest rate is on the same amount of debt, the less interest we pay, the less interest expense, the more net income is. So we have a higher value for our numerator in the formula, and the denominator stays constant at $100,000 of equity. And I'll post this spreadsheet up into our week 9 folder as well. So changes in interest rate, they will do the following. Your increases in interest rate are going to decrease return on equity. We didn't see that happen with this example because we didn't have an interest rate that was higher. So if I had imputed, a 15% interest rate in one of these illustrations, we would have seen return on equity take a drop from 19.75%. And the reason being is that our earnings after interest and taxes would have been lower as a result of additional interest expense. Actually, I would have had to take, 15% would have been right. And decreases in interest expense, which we saw, decreases in the interest rate, are going to cause increases in the return on equity formula result. And the reason being is less interest expense, causing the net profit to be higher, whereas your the denominator in your ratio stays a constant. So some of the takeaways from this analysis is that, yes, borrowing is good for return on equity, but a small business owner has to be aware of the fact that the more you borrow, the higher the risk is. And, you could be taking on more of a payment than what you're able to handle. And if that's the case, then that can just become a rolling domino effect that doesn't lead to a good place if you're not able to keep making loan payments, especially if you're not able to keep refinancing. And that can be end up being in default, and being in default is no good for many reasons. So borrowing is good for owners, as there is no ownership that's taken away. And another little topic about risk here is that risk does affect your interest rates. If you end up, taking on more of a loan than you can afford, and your payments start becoming late, that affects your credit score. Your credit score gets you your interest rate. So your credit score can take a dive, and then the cost of borrowing money is higher. The higher you borrow money, the less your net profit is, the less your return on equity is. So it is a domino effect, absolutely. So replacing the second section of the book that gets a little too technical, we're actually going to look at a different approach of looking at capital structure and talk a little bit here, starting about startup funds. And one thing you can do, and what I mentioned initially, is borrowing from a 401k, traditional IRA, or any other eligible retirement account, such as a 403b. You can't borrow from a Roth IRA. You can borrow up to 100% of your retirement savings. The benefit, if you do borrow from your retirement savings, then there is no penalty. There's no early withdrawal taxes, no penalty. They say no debt to pay off. You can pay that off by taking a distribution from those retirement funds, but that distribution then does become subject to early withdrawal taxes and penalties. So you can keep, growing your retirement savings if your business succeeds. If you borrow from a 401k, you don't have to, there's no hard inquiry done on your credit report. It's a big risk, though, is the con. You can risk your retirement savings, and seen that happen more than once. Someone take a gamble, use retirement funds to finance that gamble, and then lose big. And then retirement comes and they're out of luck. They're just living off of Social Security. Not great. Another option, and this one is actually pretty common, and that is a home equity loan, home equity line of credit. Who qualifies is a homeowner who has at least 20 to 30% equity in their home and a 650 plus credit score. And there are different ways that credit scores are done when dealing with home financing. They're a little more strict. So you can borrow up to 80 to 90% of your home's equity. Interest rates are nice and low right now, a lot lower than actually taking out a personal loan. The pro actually is that low interest rate. The cons, yes, you will have a hard inquiry on your credit report. The bigger con is, what if you can't pay back the loan? You're risking your house. You want to take that kind of a gamble in starting a business. You better be pretty darn confident in your abilities if you finance your startup funds with the home equity loan or home equity line of credit even. Personal loans, those could be advantageous if you don't want to put your house on the line. Usually you have to have a little bit better of a credit score as well, 650 plus. Your interest rate does increase on a personal loan. And generally there's some sort of a collateral that's going to have to be pledged. And you can only get so much money for a personal loan. You can't borrow as much under a personal loan as you might be able to under a home equity line of credit. So that becomes a con. Excuse me. And also a personal loan it's usually a quicker process than a home equity line of credit. Because home equity lines of credit, you have to go through appraisals and home inspections and things like that. Personal loan, you don't have to go through any of that, so funding usually happens quicker. Credit cards, expensive. That's an expensive way to get funded. So you can borrow up to your given credit amount. Sometimes that can have a 20% or more annual percentage rate. And boy, it's not great for your FICO score either. Not a con that's listed, but if you have $100,000 of available credit and you borrow $80,000, take $80,000 of advances against your credit cards, your credit score is gonna take a hit because you're using optimal amount is 30%, less than 30% of your available credit to use that. So you're limited to your credit line. The pros are it's convenient and instant. If you have cash advance checks that are sent to you from your credit card issuer, you write yourself a check, you deposit in the bank, you've got the money. And you only pay interest on the credit you use, not all of your available credit line. And sometimes you can get, if you receive cash advance checks, sometimes those do come with promotional interest rates, 1.99% APR if you pay this off within 24 months, 36 months. The thing is, you better pay it off that quickly or you're going to get some back interest that can really gang up on you. Equipment financing, not as much of a credit score requirement, but the collateral is the equipment. You can borrow a lot more money, which those in the, especially those in the farming industry, it's not hard to get $5 million of equipment, not hard at all. And usually interest rates are pretty decent. Excuse me. If you're leasing equipment, one of the cons is that you might have to give the equipment back at the end of the lease period. Another con is what happens if you can't make the payments and your collateral is your equipment, you can lose your equipment. And also a pro is you get new equipment. So some loans, some micro or nonprofits, excuse me, do what's called microloans, which they're not that much in amount, and the interest rates can be high, but the requirements are not as harsh as some of your other types of loans, like your home equity line of credit and your personal loans. So usually about $50,000 is about the ceiling of how much you can borrow. And lenders, they don't need to make a profit, but they're definitely going to because they're charging you 18 to 35%. But some of the requirements are, credit score 500, which is not that difficult to obtain, not have any recent bankruptcies or foreclosures. I would say recent bankruptcy, it would depend. Bankruptcies do stay on your credit record for 7 to 10 years. So no recent late payments on such things as rent or mortgage, and you have to have proof of income. So some of the downfalls, it can be a long application process. And you can get 50,000 is the most you can qualify for. Sometimes it's less. And less is not as good. So SBA, Small Business Association, has loans as well. There are startup loans. Not often does the Small Business Administration actually give direct loans. Usually all of these go through a bank. The requirements are more strict. The interest rates are favorable though, but you do have to have a down payment, which kind of stinks, and there has to be collateral. So usually your low interest rates, you have good terms in terms of how long of a loan term you have. It could be 20, 30 years. Cons are it can be a long application process. And we saw that recently with, especially with like the EIDL loans, the economic injury disaster loans. That's where you saw the need to have the credit score requirements. There was no down payment on those. That was part of how Congress funded, how Congress wrote the bills that funded the EIDLs. There was a pledge of business collateral though, and the terms on those were 30 years, and I believe the interest rate was like 4%. But it was a long process. It was a 3 to 4 month application process even. Family and friends, risky. It's risky to borrow money from family and friends. Any loan should be in writing, any. So minimum, maximum, basically how much do they have available? How much are they willing to give you? Interest rates, is there one? Depends on the person. Excuse me. The pros are it's cheap and convenient. Cons, things can get really awkward. If you have a business that fails and you end up owing a friend or a family member or both money, and you have to file a bankruptcy, they're out of luck. And yeah, that can get really awkward. And then there is, kind of the current factor here, the thing called crowdfunding. Think of GoFundMe. You can convince a large number of people to invest a small amount of money in your business. Generally, these are just really like gifts. Crowdfunding is not really, it's not a donation. It's more of a gift. You're giving somebody a gift. No interest rates because there's nothing to pay back. So the pro, yes, there's no debt to pay off, no interest to pay. The con, if you're very prideful and turning to crowdfunding as something that is, something that's maybe possibly an embarrassment to you. But nowadays it shouldn't be. You see so many, GoFundMe campaigns that, the shame factor has gone away, I believe. But you gotta have a pretty good business model in order for, to raise a substantial amount of capital. If you deal with venture capital, you really need to have a business that's got the potential for high growth. And you need to show some revenue before you enter into a venture capital situation. You have new investors, though. That's the big con of a venture capital investor situation. New investors mean you're going to give up control and you're going to give up equity. So your piece of the pie as the owner gets smaller. if you have a venture capital firm involved. Then the angel investors, not required are revenues, but yeah, it's helpful. It's helpful to show a revenue stream before attracting any angel investors. It's all getting the word out to the right person. It's rare to see anything over $1 million. And, one of the benefits is that usually, if someone like Warren Buffett takes an interest in your business and decides he wants to invest some money in your company, you're going to get business advice from Warren Buffett. That's pretty cool. The downfall, and you're going to give up some control. Quite possibly, you're going to give up some equity. But you might get some tips that help you become way more successful, and that can more than pay for itself in the long run. So when to use banks? You want to use banks when you can provide collateral, you have good credit, and there's no rush to getting your cash. You don't need cash tomorrow. So some of the options from traditional banks and credit unions, term loans, 10 to 15-year loans, lines of credit, commercial mortgages. Generally, commercial mortgage is going to have a little bit higher of an interest rate than will a private residence. One of the options, SBA loans. SBA loan average size is about 371,000, probably a little more than that now. Now that we have all the PPP and EIDLs that are out there from the pandemic, Getting funded, it takes a while. Not only the SBA loans take a while, you have reporting requirements that don't stop when the loan is dispersed. We have annual reporting requirements. You have to hang on to receipts and bank statements and things like that and be able to send the SBA whatever they ask for, basically at the drop of a hat. And another thing of interest with something like an EIDL, an economic injury disaster loan, you can't sell your business while you have an EIDL or any kind of SBA loan such as that. You can't make any big changes or sell your business without approval of the Small Business Administration. So you have to get out from under that loan first. If you have an interested buyer in your business, you have to pay that loan off before you can sell your business or get approval from the SBA, which I'm sure takes quite a while in that. So getting funded by the SBA, yes, it takes longer. It does take longer. I had clients that applied for EIDLs, applied for PPPs. And yeah, some of them, it was, a 2 to 4 month process at least. And these were expedited. So it's shorter than normal. But looking at APR, usually banks are your lowest option. But again, you're locked into, you need to have collateral, good credit, and the ability to wait. If you don't have that, then you might have to turn to something like a credit card, at least in getting started. So micro lenders, the nonprofits, when do you want to use a micro lender? If you've gone through the SBA, gone through a bank, and they say no, then you can turn to micro lenders. And yeah, APR is going to be a little bit higher, and you're not usually going to be able to borrow as much. And generally, you're going to have your I's dotted and your T's crossed before you ever apply with a micro lender in terms of your business plan. So you need business plan, you need financial statements, and you need to have a description of where is this money going, where's it going to go, how are you going to pay it back? And your smaller companies, if you have a smaller company or a startup that doesn't qualify for a bank loan, or you don't have great credit, then micro lender can be an option. And again, that can be an option in just getting started. Once you get established, maybe you could go to a bank loan. So online lenders, things like your Lending Tree or Prosper, or some of the peer-to-peer loaning sites that are out there. What was it? Prosper, Lending Tree, there's a few others. You don't generally need collateral for those, and usually there is a minimum credit score requirement, but it's not super high. And generally the process on that is pretty fast, but depending on your credit, look at that top interest rate. You can have 108% interest rate. That's insane. So yeah, your online lenders can rarely compete with traditional banks, and I dare say they can never compete. I don't want to say never, but never. And approval rates are higher, funding is faster. You can get money quicker. So sometimes if you need money fast and that's your only option, then it can be done. And what happens if you've got a payroll coming up, you need $5,000 in the next 3 days and you don't have it and you can't get a bank loan? Might have to turn to an online lender. The best thing that you can do if you have an online lender is get a loan that doesn't have any prepayment penalties, and hopefully have the ability to pay those funds back quickly and not have to stretch it out over the entire term of the loan, because that can cost a substantial amount of money. So micro lenders, again, profit's not their objective, they are mission based. There are some examples of these on the next screen and what group that they target, or that they service, excuse me. So they offer loans that are from government or nonprofit programs. They look at helping small businesses that are maybe underrepresented, such as women, such as minorities, such as people who don't qualify for other loans, criminal records, your bad credit. These companies will actually, fund you when possibly no one else might. Excuse me. And one thing that you do need to be careful of is this final bullet point here, as in that many of those small lenders, they may provide some counseling and training pro bono. So it might be free of charge. There might be a fee involved. So you do need to be careful, including, helping the individual build your credit. Again, you got to be very careful of this. Be careful because, there might be an ulterior motive involved. It's not unheard of to possibly turn down that advice and maybe use something like Credit Karma instead to help build your credit. Excuse me. So these are some of the examples of micro lenders. A company called Grameen America, which is geared toward women lending. There's Justine Peterson for areas such as this, which are more rural, as opposed to the heavily populated places like Chicago or St. Louis. the Valley Economic Development Company, if you don't generally qualify for a small business loan through the SBA, you can look there. There's this company called Excelsior Growth. Generally, your turnaround is less than 5 days and bad credit is accepted. Interest rates, however, might be high. This company called Action, ACCION, is geared towards individuals with criminal records and helping them get started with businesses. Because that can be, a deterrent sometimes in getting a loan as well. Generally, if you have a criminal record just coming out of serving time, you're not going to have a down payment. And you might, there'll be a lack of a recent credit history, and that can be a deterrent in getting financing as well. Okay, so we hit the final section that we cover kind of briefly, and that is the topic of leverage. Starts on 133, goes through page 145, and gets a lot more in depth than we're going to here. And leverage, the book mentions, thinking about high school physics, talking about leverage in terms of using a lever to, lift something that's heavy without having to use much weight. So leverage is more than a proportional change in one variable in response to a certain change in another related variable. A business example might be the effects of small changes in, fixed cost assets on a firm's earnings. We'll get into a couple of examples here. The book talks about the 3 different kinds of leverage, being operating leverage, discussed on 133 to 137. Financial leverage, talked about from 137 to 144, and then total or combined leverage from 144 to 145. So operating leverage is the responsiveness of the change in profits due to the change in sales. So you can have potentially use fixed operating costs to show effects of changes in sales on operating income and EBIT, earnings before income and taxes. So if you have a company that has low gross profit percentage, their cost of goods sold is a higher proportion of their total sales price than another company that might have a lower cost good. So generally you're dealing in not making much money off of each product, but selling a lot of product. So what you're not doing as a company in high profit, you're doing high volume. So the 2 examples that are basically given to show the difference between high versus low gross profit, Microsoft versus Walmart. Walmart doesn't make a whole lot of money selling, something like Halloween decorations, but if they sell a lot of them, then that little bit can keep adding up. Microsoft, however, has more of a gross profit percentage for their items. Or, another computer manufacturer, if you look at the computer manufacturers, someone like Hewlett Packard, they have an item with a higher sticker price and more of a, the cost of goods sold is not as high of a percentage as is, say, Walmart, but they don't sell as much product. So your low operating leverage, your company has low gross profit. You don't have a lot of money left over after just turning the profit over or the product over. So you make up for that by selling mass quantities. And those industries are deemed to be lower risk than are those with high operating leverage. So that's a company that has a high gross profit percentage. And we'll look at a little example here in a few, where each sale contributes a large amount to overhead. So gross profit, again, being sales minus cost of goods sold. So generally what you're looking at is the percentage of cost of goods sold to sales. For that high operating leverage firm, they're going to have a low low percentage of cost of goods sold versus the other type of company. So your Walmarts that have a low gross profit percentage are deemed less risky than are the Microsofts because they are able to sell more products and make money that way than is Microsoft. They have to have actually a better quality than, and focus more on quality than they do on quantity. And that is the difference between the low leverage and the high leverage companies. So putting some numbers to a company that's low leverage versus high leverage, your low leverage company would be the one on the right side with the 10% or 1/6 gross profit. So of every dollar in sales, they bring 16.7 cents returned in gross profit. From that, overhead is subtracted, as is the rest of your regular expenses, your variable expenses. So net income can be the same between the two companies, but that company on the right is going to have to do more volume in order to make up for having a higher cost of goods sold. So generally your lower operating leverage firm is not going to have as high of an overhead as does the firm with higher operating leverages, as we see on the left-hand side. Those firms, such as your Microsofts, your Hewlett Packards, the companies with the bigger ticket items that are more focused on quality than they are on quantity, more of their investment is going to be tied up in their overhead than it is tied up into employees, really, and doing high volume. They're doing lower volume, but having more of the processes being automated. So overhead in those firms would be higher, making that a little more risky and possibly a little more rewarding. It's high risk, high reward. So you can have, and I was kind of getting at that just a little bit here, a capital versus labor situation. And if that is the case, then due to capital purchases, your overhead will increase, and hey, that's our high operating leverage company. Has more overhead, has bought more equipment, won't need as much labor. So the variable costs tend to decrease, which variable costs are more tied to labor and things like that. More units. and your gross profit tends to increase. So if we look at two companies, one that focuses more on labor, one that focuses more on use of capital, they can have almost exactly the same results of operations as these two companies do, producing the same number of units, selling the same number, selling the units for the same price. Company A, which is more labor intensive, is going to have a lower contribution margin or a lower gross profit than will company B, which has invested heavily in capital. Where they're going to have a difference, though, is going to be in those fixed costs. Company B is going to have more fixed costs, have more equipment, things that are more pricey. You got machines automating your processes, you have more machines, you got a lot more expensive items which are being depreciated, those being your fixed costs. So for the company who is using more labor, they're going to have to pump out a lot more product in order to break even. Okay. So if you look at your low versus high overhead companies, where do you want to be? Ideally, where the risk and reward are approximately equal. So where you have a mixture of automation plus using some employee labor as well. You can't completely cut the employees out of a company. So growing companies, operating leverage actually decreases as time goes along and as sales increase. Excuse me. So these would be like your sales volume on the left and your leverage to the right. So operating leverage as your sales increase, this follows the law of diminishing returns. As your sales increase, your operating leverage it decreases as time goes along and as sales increase. And with a growing company also, if you have the same proportional increase, ratios will fall. Okay. So we'll look at a little bit of what's called degree of operating leverage. That discussion actually begins on page 134 and goes through to 136. So a few different ways of calculating degree of operating leverage as opposed to what the book has presented. Basically, one possibility is to take your percentage change of operating income and divide by your percentage change in revenue. So this is using a little bit of what's on page 136. Actually, we end up with a 2/1 degree of operating leverage. And this calculation can be done over time and done using different companies to compare those. Second calculation uses contribution margin. The contribution margin divided by total operating income. Very close to what we saw before. It was 2 instead of or versus 1.98 rounded up to 2. So degree of operating leverage Pretty close, actually, depending on what methods you use. So you can do a little bit of a proof here to determine that, yes, as the firm gets bigger, the degree of operating leverage does decrease. The way to do that is to put some numbers to it. And this is just an illustration. Nothing will hold you to on a test or quiz or anything like that. So financial leverage is basically the last topic discussed in the chapter. The conversation starts on 137. You're using what's popularly called OPM, other people's money, or trading on equity or debt financing. So you're using borrowed money to increase production volume and subsequently sales and earnings. So financial leverage is generally the ratio used is your ratio of total debt to total assets. And it is calculated exactly as that. If you go back to chapter 6, where we discussed, the different ratios, the debt to assets ratio was actually in, that was one of the debt ratios, specifically page 113. The debt to asset ratio is, total debt, total liabilities divided by total assets. So in boom periods, beneficially high leverage. If you have a lot of borrowed money, then yes, you're going to have a greater amount of financial leverage. Might help you out in boom periods where everything's going great. You might have additional cash because of having operations which are being financed through debt. However, once if you're in something like a seasonal business, if something happens to your demand, that the demand for your product is decreasing, then that can cause cash flow problems. Might not be enough sales revenue to even cover interest payments, let alone principal payments. So usually something like that, you're looking at something more like a line of credit. And so that's why principal is really not discussed here, but sometimes you have to cough up the money for principal. And if you're not even able to cover interest payments, you're in a world of hurt. Kind of like our federal and state governments. They can only pay interest on the national debt, not on the national debt itself. So a couple of examples of financial leverage. What if you decide to have $10,000 and buy a small amount of inventory and sell that for $1,000 versus option 2, have $10,000, but I'm going to borrow $990, buy $1 million in inventory, sell that for $1.1 million, make a gross profit of $100,000 before taxes, pay $10,000 of interest, you have a net profit of $90,000. On the flip side, though, what's not really discussed here, you'll also have a note payable of $990,000, which will eventually need to be dealt with. So, it's a decision. It's definitely a decision to be made. How many times can option 2 occur? Covers our material for the week. So the next topic we'll have is a little bit of discussion on the mini research paper, which is on leverage, and it's really just one of the discussion questions in the text and just in the form of a small paper. So again, just 1 to 2 pages. Just discuss the concept of leverage and why a firm might need leverage in doing business. You can use the textbook for a source, at least one additional source. Again, no more than 1 inch of margin, double space, and we will use Turnitin for submission, and the Dropbox is out in Sakai. There I am. There's Sakai. And here's our Dropbox for our mini research paper right here. And so it'll just be a file attachment to this Dropbox. Okay. So that ends our chapter 7, and I do apologize again for having to cancel tonight, but I did not want to bring this to y'all because there was some sore throat happening, there's coughing happening, and all came on all of a sudden, and I was like, oh no. So I do have a COVID test in my future, and probably sometime this week for sure, possibly tomorrow. So for next week, which would be Monday the 2nd, we'll want to reread our chapter 7. I'll come up with any questions on that chapter. We're actually talking about the basic entrepreneurial management next week, which is, it discusses some items such as planning in business, organizing, talks about staffing, talks about directing a business, controlling a business, different kinds of leadership styles, business strategies, and it's just kind of a very basic and very it's kind of topic heavy chapter, concept heavy, not calculations at all. So we all also, what we'll assign next week will be the next quiz. I did have one on the syllabus for this week, but I decided instead that I would combine chapters 5 and 7 into, 7 and 15 into a quiz that'll be 10 questions, just like usual. So our mini research paper on leverage will be due at the start of next class period. We'll have 2 number phobic chapters to be presented, and excuse me. And our next quiz won't happen until after next week's class, so there is no quiz due for this week. If you have any questions, please do let me know, and we will, barring anything unforeseen, be back in class next week, and we'll see you then. And in the meantime, if you have any questions, you're free to shoot me an email, course message, whichever you like. Hope you have a great week. Stay safe and healthy, and we will see you